Hello, everybody, and welcome to today's webinar, How to Invest in Real Estate with Non-Traditional Retirement Accounts. Today's webinar is sponsored by Rocket Dollar. Rocket Dollar account holders have the power to invest in any asset class allowed by the IRS, invest securely and easily in real estate startups, and more. Open a self-directed solo 401k or self-directed IRA with Rocket Dollar and put your money to work today. We are recording today's webinar. After the webinar is over, I'm going to email you on how to access it. And you can put your questions in the chat box that's on the right side of the screen. The slides can be found on the left. You'll just have to click where it says webinar slides, and then that download file button will light up. When we get to the final slide, there'll be a couple links on the screen. One will be for the valuation. You'll click it. Let us know what you thought about today's webinar. The other link is for the affidavit, so you can get credit for this, for the CRS designation maintenance. And you'll just click on that where it says webinar affidavit. It'll take you to CRS.com, ask you to log in, and then you'll see RRC webinar affidavit. You'll click on it, put in your initials, hit submit. That's all we need to do. I'm very excited about today's webinar because we have a great speaker with us today. Henry Yoshida is joining us today. Henry's in the Austin, Texas area and is the CEO and co-founder of Rocket Dollar. He is a certified financial planner, practitioner, licensed real estate professional, and has 17 years of experience in finance. There's probably not a better person to have on here than Henry. So, Henry, how are you doing today? Great. Well, you know what? I know you have a ton to
I'm doing great. Thank you very much. Thanks for asking. So coming in live from Austin, Texas today. Sure. Perfect. Well, look, I appreciate it. Again, my name is Henry Yoshida, and I kind of bridge a couple different areas. So I spent the bulk of my career working in financial services and specifically with retirement accounts. But I do keep a real estate license on the side. So I'm always kind of thinking about things from the angle of what the audience might benefit from. And coming together for this webinar and planning it and putting together the slides, we really thought about a way to sort of introduce retirement accounts in a non-traditional way that allows everyone on this call to take advantage of their expertise. And we kind of divided into two prongs. So one of which would be for themselves in their business and generation of more business, and then to do more sales. And then the second would be actually as a financial planning technique for your own specific business as well. So I'll get in. That'll make a little bit more sense as we go through. So I appreciate you going over the high level of my background. And I've since, I guess, turned now over the last few years to building financial products. So the current one that we work with is Rocket Dollar. And for those on this webinar, you may have heard of a particular investment product before called a self-directed IRA. So Rocket Dollar is a digitally enabled self-directed IRA provider and self-directed solo 401k provider. So people can actually use tax qualified accounts and do real estate purchases as a way to increase sales from existing clients and or for themselves in the form of a self-directed solo 401k for the retirement planning of your own particular real estate businesses. So, one of the things that I've kind of faced since starting this business and also just in general talking to folks in the real estate industry, and this kind of came about, we presented at a couple of conferences related to real estate practitioners, real estate sales professionals, and so forth. And we get a lot of these types of questions. So I thought I'd just kind of summarize here, but it's a did you know that you can use retirement dollars to invest in real estate, and people may be aware. And then second is that what is it that I use that term, a self-directed IRA and a self-directed solo 401k. It's a little bit of a misnomer. So the answer to number one is that yes, you can if you use a self-directed IRA or a self-directed solo 401k. So people might ask, okay, well, Henry, naturally, that brings up the next question, which is, what are these types of accounts? So a little bit of a misnomer in the way that the accounts are titled, but really this type of IRA, self-directed IRA or self-directed solo 401k really just refers to a retirement account that allows you to invest in something that is not a stock, bond, or mutual fund. So these are your S&P 500, Dow Jones Industrial Average, and or just mutual funds that pretty ubiquitous now. So if you have a retirement account that can invest in anything that's not one of those things, then it's actually self-directed. So self-directed doesn't mean that you make your choices inside. It just means it allows for non-traditional investments, of which real estate is one of the most popular options, directly owning real estate. So then we also wanted to go over 5 particular strategies on how to use these accounts that we've seen in our own customer base. So you can increase your own sales as a real estate sales practitioner, and or your own personal investing while also saving for retirement and capitalizing on everyone's expertise on this call. And Paul is going to help me throughout in case questions come up, since this information here, people are going to want to have some questions answered. We'll leave time open as well for Q&A at the end. And then on our site at rocketdollar.com, we have a lot of resources. There's a search bar there on our FAQ, frequently asked questions, that are specific to real estate investing using our account. So that probably goes a little bit more into the details of how and why and when it's appropriate to use these types of accounts. So that's another resource too, in case in just a free-form conversation medium, it's not easy to get detailed answers to your questions. So we want to make sure that we can direct people to get as much information as they need. And of course, you can also schedule time to talk with someone on my team as well. So just let me kind of talk about this one real quick, the disclosures. But we, in and of ourselves, are not tax advisors and or investment advisors. We merely allow for the creation of the platform that will facilitate you opening an IRA that is capable of investing in things that are non-traditional stocks, bonds, and mutual funds. So the obligatory disclosure slide. So just want to get that out there. But let me kind of frame exactly why I refer to that term traditional retirement accounts. So in the United States today, there are almost $10 trillion in just what's called IRA accounts. So that stands for individual retirement accounts. And of that, there's an industry that's existed in parallel that has allowed for these self-directed IRAs or self-directed solo 401ks. It's existed just as long as the household financial services names that that you might have an IRA with right now. And that particular industry has amassed almost $10 trillion. The other industry makes up only about 100 to 150 billion of anything in alternatives. So that includes real estate. That could also include just other non-traditional investments which qualify to be in these accounts. But today, of course, we're focusing on real estate. So one of the things that I bring this up for is to show that there might actually be a lot of opportunity for the practitioners and agents in the real estate space here to actually work and generate additional sales with clients in between the purchase of a primary residence by introducing a concept where they could use their own existing retirement accounts to buy rental properties. So this might give you the ability to expand beyond just helping individuals locate their primary residence that they might live in, which is not something they may do every year or 2 years. Obviously, the cadence and the turnover of that could be much, much slower. But this might be a way for you to kind of stay top of mind and add an additional value proposition to customers in your database to allow them to tap into monies that they, quite frankly, already have in the form of $10 trillion, and maybe introduce and you can showcase your prowess in helping them identify good investment properties that they could also own in these types of accounts in between the primary home purchase. So big, existing pool of capital of which can be tapped to your benefit in increasing sales. And, I brought this up earlier that it's a low percentage of the overall IRA assets. And we always ask ourselves, why is that? For us, what we find is that actually real estate professionals and real estate investors want to buy more rental property. Anyone that's already gotten into it typically wants to buy more. But, inevitably what ends up happening is that you end up coming up against a lack of liquid assets to be able to make those investments. And then specific to being able to know how and when to use a tax qualified retirement or old 401k type of account to do so, there's just not a lot of existing knowledge out there that you can use these types of monies to invest in retirement savings. So a lot of people think IRA, they think I could just purchase stocks and mutual funds inside of it. And then for those that even when you become aware that these funds are available, it's actually pretty difficult. So A lot of different providers out there.
Oh, Henry, I'm
Not
sorry to
exactly a
interrupt.
simple
There was
process
a
of
couple
opening an
people
account
wanting to
now with a
know
simple app.
if we could
And
increase
our
the
goal at Rocket
volume
Dollar
a
is to
little
make it
bit.
easy. So we want to
I don't know
basically
if you have a way
introduce
to.
the concept that there's monies available that
Yeah,
can
I
go
think so.
into non-traditional investments, including real estate. We want to help you guys and arm you with knowledge on how
Yeah,
best to do this.
yeah.
And then our platform itself is designed to make this easy for you as well. So, you're, yes, sir. Sure. Oh, okay. Am I coming in louder now to you, Paul? I'll let you. Okay, is that better for you? I just raised the volume on my microphone. Is that better for you, Paul? Okay, perfect. So we want to make it easy for you and your clients to buy real estate with the old retirement accounts. And the best way that we can think to do this, in my expertise and what I've been doing for the last few years, is creating a technology platform to give you access to these retirement dollars, a place where I've spent basically my entire career. Uh, Give it to you in a digitally enabled platform at a simple and easy to understand price. But then on the back end, we also want to arm you and provide the information that you need to help understand how these accounts work, help you make those sales, and then also for your end customers and clients to be able to go to as well and get their questions answered. So again, it's a concept that's existed since 1974, which are retirement accounts and IRAs. It's always been capable of doing investments that are outside of the stock and bond markets, but it's not widely known and not widely utilized, except to the tune of roughly 1% of the $10 trillion market, to go into any investments outside of that with these accounts, including real estate. So, what we talk about in our particular product is that we want to make the transactions fast and easy for you. Um, in addition to people already having $10 trillion in these accounts, people can also put an additional $6,000 per year into this particular IRA with us at Rocket Dollar or another provider that offers self-directed IRAs. Uh, and they can do that on an ongoing basis, and that'll get adjusted on a year by year or periodic basis based on inflation and cost of living adjustments. So to make investments into real estate, this also includes things like private equity. And so we'll talk about some other examples of investments related to real estate that we've seen our own clients go into while enjoying the same tax advantage treatment of an IRA. So let me kind of explain here real quick what those are for those that may be knowledgeable in terms of knowing that there's IRAs, but just explaining how the taxes work. So essentially, in an IRA, you're able to make investments and defer the payment of taxes until you take money out of the account. And in the United States, you're not able to take money out of the account without particular circumstances before you're the age of 59 and a half. So for individuals in their 20s, 30s, 40s, and even 50s, you can make investments today, and as those investments create income and or grow, you could essentially keep reinvesting those monies without having to pay taxes on the gains until you decide to take distributions out of the account. So it's a pretty powerful way to accumulate large sums of money, which is another reason that speaks to why IRAs have become a very popular holding investment vehicle for many decades now. Um, that's specific to the IRA, and I mentioned as well the self-directed solo 401k. So this is a two-pronged presentation, one of which is help to design you how you might be able to position this particular strategy or product to generate additional sales from existing customers and clients in your database. Another is for all of you to actually use this vehicle for yourself. So by and large, the vast majority of real estate professionals typically work for themselves, even if they have an affiliation to a larger organization. So they generate independent 1099 income. Um, and I've actually just myself got invited to participate in a webinar for wealth management planning for real estate professionals. And a lot of that was kind of concentrated on the assumption that many of us work for ourselves. So whenever we're running our own business, we have to kind of set up all of our own infrastructure. So that might be health insurance, that might be retirement plans. So the difference between the self-directed IRA to generate additional sales for your customers and the self-directed solo 401k, which would be used for you in your own practice, is that a couple things. One, you have the ability in 2019 to actually contribute up to $62,000 a year. And any contributions that go into a retirement account are actually a reduction of your taxable income. So just to make it easy, if you made $200,000 this year as a real estate professional, and you have a solo 401k for yourself, and you make contributions and make a profit sharing and a match to yourself, you could actually put away maybe 20, 30, 40, 50,000, and your 200,000 income will register as 160, 170, or 180 for tax purposes. And then the balance that you put into the retirement accounts is now available for you to use as an investment. And in our case at Rocket Dollar, they're self-directed solo 401k, so you could accumulate dollars and then go into your own investment properties for yourself with the exact same tax advantages on the right-hand side of this slide. So that didn't change from the slide before. The investment options didn't change. The contributions, that changed. So for yourself as an independent business owner, if that's how you're structured, and many real estate professionals are, you are able to do that to the tune of up to $62,000 per year. That's inclusive of profit sharing, match, and your own salary deferrals. And the other capability, kind of going from right to left on the screen, is that if you have an old IRA or an old 401k that you roll in, create an individual one for yourself, you actually, as the owner of the business or the sponsor of the 401k plan, you can actually borrow money from that plan for your own purposes. And basically, you're functioning in this case as both the bank and the borrower, since it's coming out of your account. And the maximum for that is the lesser of 50, or the greater of, or the lesser of $50,000 or 50% of your account balance. So if you have $100,000 or more in old IRAs or old 401ks, you're now in the real estate business, you want to take some money as a loan, as a business loan to yourself, and pay yourself back. To do that, you can actually use those monies to just kind of get your business started. So that can be used for marketing expenses, office space, whatever it may be. And I've talked to people, and we facilitate this for.
Oh, hey, Henry, I did have one question here. Just came in. They want to know if this deduction that you just got done talking about from taxable income is the same if you file as a sole proprietor or LLC.
For $30,000 for business startup costs, for example. So we'll go into that a little bit more. I typically get a lot of questions related to that. So Paul, just feel free to interrupt me at any time as they come in, and I'm happy to answer those. Yes, sir. Yeah, so it's the same because both of those, if you're an independent business person, kind of flow back to you. So the deduction you would be the same, essentially, in terms of lowering the income. But again, however you have this set up, you consult with your tax advisor. But under most circumstances, the monies that you could put away into your own solo 401k, if it's self-directed, that would allow you to do alternative investments, including real estate, and capitalize on your professional expertise. Everyone on this call, of course, presumably is on here because of specific expertise in the area of real estate. And if it's a traditional solo 401k, then it works no differently than a regular 401k at a major corporation like Microsoft. If you work there, you just go into mutual funds. But regardless, the dollars that you put in will be a reduction of taxable income as you're qualified to do so. And in this case, I put 62,000 because if the people on the call here worked at Microsoft and contributed to the 401k, the typical company might have just a match for the first 3% of your salary. They're typically not going to give you, 20, 30, 40, $50,000 from the company side if you only put in $10 or $15,000. But in this case, remember, it's a one-person business and you're making the decisions for yourself. So you can give yourself a very large profit sharing, of which you'd be the only person participating in, and the 62,000 is the top level for this year, 2019, IRS limit. If you're over age 50 and you take advantage and you make enough income to so qualify to put the maximum amount of dollars in. But obviously, as you can see, depending on where you are in your tax situation, this is a pretty, we like to refer to it actually as a very sort of hidden financial weapon for independent income earners that, quite frankly, a lot of people don't know about. I was happy to see that a couple of people I know personally have since written a couple of articles, one of which was syndicated into the Wall Street Journal recently, about specifically what I just said, that the solo 401k is one of the most underutilized financial planning products out there. So for folks. So hopefully that answered that question, Paul, that came in just quickly. But again, much more detailed answers on our site or after you consult your tax advisor in terms of how you have it set up. The only reason, and this is not related to the treatment, that you wouldn't be able to set this up is if you have employees on your payroll. You can only set up a self-directed solo 401k if it's just yourself or yourself and your spouse if you're filing as one joint tax entity. So hopefully that helps clear up another question. This one I'm going to just kind of put up here. This is a little bit more of a disclosure slide as well. And this is something that you are going to want to consult your own tax advisors about. But I didn't highlight this as one of the main differences and one of the main sort of benefits of using a solo 401k for your own investments versus an IRA, potentially for your customers. I'm going to make the presumption that most people here don't actually need a self-directed IRA for themselves because they probably are in a business structure as a real estate professional to where they could probably set up a solo 401k instead, which would achieve the same things. But there is one difference. So for those of you that might be pretty knowledgeable or already pretty active real estate investors yourselves, that you would understand these terms, UBIT and how that's created, and how if you use a tax qualified account, you would have to do what's called proportionality for the parts that you might finance using debt and leverage, and the parts that you're actually just contributing equity in from your IRA or 401k to invest in. But one of the big advantages of using a 401k is that you don't have to keep track of that proportionality, that you can lever up properties in the form of non-recourse loans, which are the only kinds you can use when you're going leveraging against equity in a tax-advantaged account. So there's a lot on this slide, but I would say that, you know, rather than kind of getting into the weeds and answering questions for the proportion of people or the small portion of people on this call that may be already utilizing one of these vehicles and utilizing leverage to do so, that this is something that, you know, you're going to want to consult our site. We have a number of articles on and or have an offline conversation with one of our folks to just kind of really understand, you know, how you might be able to use a self-directed solo 401k that you fund with a former big corporation retirement account, let's say $200,000, and you buy two properties for $200,000 and finance 50% loan to value, versus your self-directed IRA. If you open one of those and put $200,000 in, you probably would just buy one property and finance it 100% equity from the $200,000 of the self-directed IRA. So a lot here. The intent wasn't for me to read this, but since everyone will get a copy of the slides afterwards, I thought it was a nice bullet point reference for folks as they start to study and understand a little bit more about this. Save you some research times if I put some of these bullet points, and then it'll give you a good footing to have a conversation with us, have a conversation with another provider that you might use, and also to, you know, have a conversation with your own tax professionals about the differences in the UBIT and proportionality treatment in a solo 401k versus a self-directed IRA. And then this one kind of goes into the 5 strategies that I wanted to highlight, just at a high level of ways that we've seen our own customers use self-directed IRAs and self-directed solo 401ks. And again, I hate using the word self-directed, but it's the one that is the technical term. But really utilizing any retirement type account to invest in something that's not a stock fund or mutual fund. In this case, you know, I think many people on this call would agree that real estate is an outstanding investment to own if you were going to invest in something outside of the traditional. So strategy 1, I referred to this earlier as one of the advantages, is that you can loan yourself $50,000. So if you're getting started and or already established in the real estate industry, but you may have come from a different industry where you had a traditional retirement account and or an IRA that got created by way of rolling over an old company 401k, and you establish a self-directed solo 401k with Rocket Dollar or any provider, you can actually take a loan out to yourself for up to 50% of the balance, or 50,000. And I mentioned earlier, whichever is the lower of the two. Let me give you kind of number examples. Of course, if you just have a $50,000 401k, a solo 401k, then the max loan you could take is 25,000 because that's lower than it's 50% of the balance. In this case, 25,000 is lower than 50,000. But if you have 100,000 or more, and even if you had 200,000 in your self-directed solo 401k, the maximum loan you could take to yourself is still 50,000 because that's lower than 50% of a $200,000 account or $100,000. Um, the interesting thing is that the documents, the online documents we generate, are that you essentially take the prime rate plus two is kind of just the standard. But again, you're functioning as both the bank and the borrower. So the payments on the payment schedule are actually going back into your own account. So as of what we last checked, that rate would be 7.5% interest, but the interest that you're paying back on your monthly payments essentially go back to yourself. And lastly, I mentioned that in this particular case, these dollars are monies that you're borrowing out of your account, and they do not count as a taxable distribution, and they could be used for you for any purposes. So I use the example of maybe some of the startup costs for your business related to new office space or getting your first marketing plan set up. But it could also be as well for you to do real estate that's not inside of the account. So you could do like a quick like fix and flip, for example, loan someone else the money, whatever you want to do. So that's just strategy one of something you can do out of a self-directed, in this case, solo 401k. And this is the product, just to keep everyone aligned, that the solo 401k is the product that we think is going to actually be relevant for many of you on the call. Whereas the self-directed IRA, I think, is a good talking point for you to have a nice value-added proposition conversation at the very least with existing clients in your database that you might have helped in the past for their primary family residence where they live in. And maybe see, you're going to find out that people have quite a bit of money is accumulated in these IRA accounts spread out across many old companies and or financial services providers. And they're thinking to themselves, probably like some of us on the call here, that the stock market itself has had almost a 12-year run up, and maybe that's not sustainable. So they very actively could be looking or thinking to themselves about diversifying some of these monies in these accounts. And of course, you present opportunities in the investment side of your database to maybe connect to those individuals. And that's an easy new $250,000 sale when you might have presented and sold them their $650,000 primary residence that they live in last year. So we've seen a couple of realtors. Actually, one of the anecdotes, of course, is that we've gotten calls in early from realtors themselves that said that it was one of the easier sales that they made, which was just tapping into one of these old accounts. There was no financing involved. Client just wanted to diversify, wanted a $200,000 rental property. That's it. So strategy number two is that out of these accounts, once you have your own self-directed IRA or self-directed solo 401k, you don't have to directly just invest in real estate, but you can do a number of other options. So I mentioned that self-directed refers to anything that's non-traditional. So you yourself can actually become a private mortgage lender to someone. You could offer someone a hard money loan, a promissory note. You could also buy options on land or invest in tax liens. So my role at Rocket Dollar is not to be the sort of surfacer of investment opportunities or give them out to folks themselves. I kind of feel like a lot of people on this call may have access to ancillary investment opportunities that are in and around real estate. So I just kind of wanted to give some examples of tangential investments that may be eligible outside of just purchasing a direct property outright. So that's what we wanted to highlight as strategy number two. And then strategy number three, probably most popular, is just to buy and hold rental properties. So the 401k or the IRA LLC, inside of the accounts, it receives the rents, it pays the bills, it holds the cash in reserve, and holds the proceeds from the sale. And on this bullet point, I kind of wanted to explain that for those of you that have a regular investment account in the form of an IRA I just heard a beep there, from a provider like a Schwab or Fidelity, it's no different than if you own, and I would keep using the Microsoft example. Microsoft pays a dividend of 2.5% right now. And if you own it inside of an IRA, you can take that dividend in the form of cash, but you don't have to pay taxes on it. It just basically accumulates as additional cash on the side inside of your IRA. So if you own a rental property inside of an IRA with a provider like Rocket Dollar, who allows you to self-direct the account, and as rent checks come in, those can accumulate as cash, and at some point it could build up to the point where you might have the capital to go and purchase an additional property. So it's the same thing. It's not coming to you directly in the form of taxable ordinary income, which is typically how rental properties are taxed to the owner, the landlord, right now. But instead, they accumulate inside of the IRA account, at which point you can defer those taxes until you want to distribute. So, of course, under most circumstances, after the age of 59 and a half. I mentioned earlier that you could leverage with a non-recourse loan, and this went back into that somewhat busy slide there that I put in more as a reference. That if you leverage, then you have to keep track in an IRA of proportionality for UBIT, UDFI, and file a 990T. If you do it inside of a solo 401k, then this proportionality tracking is basically, for the most part, rendered null. Again, it may still trigger some state taxes, so that's different. Here in Texas, we don't have a state income tax, so that could be different depending on where people are chiming in from on this particular call. Again, I would basically get a good foundation of information from our own site and look at those FAQs and articles that we've already posted up there, and then that would give you a good base to have a conversation with the current tax advisors that you already work with in your own particular business. And then, just a couple of other bullet points there that the IRA can do a 1031. The IRA LLC registration is with the state. And then you could do other types of property. It doesn't have to be, I use single family homes as the number one example because that's what we see the most of. But this could also work for land, timber, multifamily if you have enough money inside of the account to do so. And that's the most common strategy that we see now. And I've seen a lot of use cases. So myself personally, being an individual who works, who has worked in my career as a certified financial planner, but also as a licensed realtor, I get asked a lot about, taking some chips off the table that might be invested in the stock market and going into investment real estate. So I think it's something that allows you to basically maybe tap into some of the monies that are held by the financial advisor relationships for some of your clients today, and basically give them a great investment, also make some money in doing additional sales. And I think more importantly, it gives you a way to sort of stay top of mind and present a different part of the expertise that I think all of you on the call and the webinar already hold, which is access to great properties, both from an investment standpoint to live in a primary residence, but also to be able to present investment opportunities just for single family rentals and buy and hold rental properties. So I think it's a nice way to generate additional sales. And we've had clients that have told us that they want to make a proactive decision to basically get one or two properties every few years, and they want to do so inside of these IRA accounts because after working, let's say, for maybe 20 years for the same corporation, they've accumulated close to a seven-figure amount in these types of accounts, which in the traditional structure is invested 100% in the stock and bond markets. So they want to diversify out of that into something like real estate that may not be as correlated. And then strategy 4 is that you are able to fund fix and flips as well. So many real estate professionals do this. You might have clients that come to you and look for these opportunities specifically as well. They can do so out of their IRA or solo 401k under one caveat, that if you are too active in doing this strategy, the fix and flips, it may be perceived by the government that you're running an active business. So one of the rules of thumb that's pretty much held up is that, one flip, it's not going to be counted as a business. Two flips, you're kind of getting into a gray area. But if you're starting to do 3 or more flips per year using your retirement account, that's actually operating an active business, and not a good idea. I think your tax advisors will tell you that you need to have this separate outside of tax qualified monies because it's too actively involved in a business if you're doing 3 or more a year. So again, I don't know the exact makeup of everyone on the call today, but I did try to think about situations that have come up more than a handful of times in our particular running of this business related to real estate uses for self-directed accounts, and highlight those, thinking that it will be relevant to some portion of the audience here today. So that was the 4th strategy. But again, possible to do fix and flips, but with the caveat that you don't want to be too active inside, and you can do that with your IRA or old 401k monies. either for yourself in the form of a solo 401k or your clients coming to you that may have that old 401k or IRA account from previous employers. And actually, before showing strategy 5, I've worked with IRA accounts now for, as the first slide said, over 17 years. And what you're going to find is that many people actually have multiples of these accounts, and for pretty large amounts. And you get a lot of sort of eyes opening up wide when you finally introduce to them that they may be able to do something related to real estate with these funds. Many people view these accounts as kind of locked up. I just leave it in the stock market. I've been told, or I just have this understanding that I can't use it until I'm over 60 years old. Most people don't know that it's specifically 59.5 years of age. So they kind of use 60 or retirement age. So just being the person that identifies to them that they can unlock these monies for investment purposes, real estate being one of them, actually is a you're kind of an interesting person to them. You provide some value proposition just for bringing that up, and I've seen this hundreds of times just in my own life. I guess in a way, what I do at Rocket Dollar, what I've done in the past, has sort of led me to be in a position to be that one that gave those individuals an aha moment, and allowing them to unlock those funds. And then strategy number 5 is that you can participate in a self-directed IRA and a lot of other tangentially related things to real estate. So you can be a part of a real estate syndication as a partner in a fund. You can invest because your knowledge you would know what relevant technologies are coming up in your space. Real estate tech is one of the most hotly funded spaces right now, and I think that everyone on this call who's a practitioner, boots on the ground, working in this day to day, probably has a little bit of a leg up in identifying what those next great new technologies could be. And if you have the ability to get involved with some of them in an early capacity, you could do so. So I've done that myself as an early angel investor in some real estate technology startups, either through syndicates on websites such as AngelList or Republic, just because I have a little bit of knowledge in the space, and or directly into the businesses themselves. I've also participated in syndicates as well for commercial properties. And if you just want to stick with the public real estate investment trust market, those are available through your traditional brokerage and IRA accounts. But if the funds are not registered publicly and they're private, then the way to go about it would be through your self-directed IRA or self-directed solo 401k, both on behalf of clients or yourself. So those are kind of the overview of the 5 particular strategies that can be used for a self-directed IRA or a self-directed solo 401k. And then again, this is just a quick self-playing part to show you that for us, we've really tried to mimic on our technology platform the very sort of known protocol that exists today in opening any investment account at one of the name brand online brokerage providers. So I mean, at the end of the day, the world of investments today is you basically go online, and it's probably a given today that you have to be able to open an account online. You sign up for that account, and then you go through a process to then fund that account. So in our case, I've talked a lot about folks having multiple old accounts, and you're going to find that a lot of your clients in your database probably have significant dollars in these accounts that are being held by financial advisors, other professional services providers, and you might be able to tap into some of that monies to present them or sell them investment properties in the maybe 7-year in betweens of the primary residence sales, and really be that sort of top in mind additional professional service provider with an investment opportunity. And the way you have to do so is by rolling over those old accounts from Microsoft's 401k, from a Charles Schwab IRA, and putting them into the account at Rocket Dollar, so the customer can self-serve and fund this. If it's a solo 401k, you could do this as well from your existing traditional accounts into your newly created self-directed solo 401k. And then at that point, you're essentially operating a custodial bank account with the tax treatment of an IRA or 401k, and that's what you would use to, the most normal example in the real estate world is purchase a property outright. And I don't think that this particular last step, making the investment out of a bank account, is really any different than how you might be purchasing investment properties today, basically out of an account that you have dedicated to making real estate investments. and just cutting a check or wiring funds or certified check out of that. So for us, it's the same three-step process, which I think is pretty much expected now in 2019, about 15 days away from 2020. Um, just fund and invest. And then I mentioned earlier that for me, I think another way to differentiate in this product set for self-directed IRAs is just to have a really simple, easy to understand pricing model where it's just a one-time flat fee to sign up and then an ongoing maintenance fee from our side to keep the account in good standing from a tax standpoint versus if for those of you on the call that may have experience with other providers, it's pretty long laundry list of what fees you either pay or don't pay depending on the actions you take and what that may trigger inside of the account. So just to show that. And then for us, the business model is simple. We have just a basic tier and then an enhanced tier, which most of our real estate investors use the enhanced tier because it allows for a certain number of wire transfers in and out of the account per year. You also get access to a debit card, so you can do the things that you need to do to maintain a property or your client to maintain a property using that same IRA bank account on the right-hand side. So that pricing tier is just $630 a month in terms of our business model. And then, of course, we additionally do issue physical products for people to manage that property. So probably very similar to how you're managing an investment property today with taxable monies is that you have a dedicated separate bank account and you operate a property out of that account. So what we do, since we house the money inside of a bank account, we maintain it for tax purposes as a 401k or IRA. We provide to you those same tangible physical products in the form of a checkbook and a debit card to maintain your property while keeping track of all the transactions in and out related to management of that property inside of your IRA. So it's all kind of there nice and neatly packaged for you. And I referenced this many times. So FAQ is the more known term, frequently asked questions. I've been told by my team the more modern way to refer to a FAQ today in the technology world is knowledge base. So I lost that battle and ours is called a knowledge base. But for those of you like me that are over 35 years old, it's an FAQ in the form of a knowledge base with a search bar. And that's where you can find answers to a lot of your questions. And then just other things that you can do to share as well with clients are that we are pretty active in the blog space as well. And there's a number of them that relate to the whys of alternative investments, the whys of maybe real estate investing as one of the asset classes that you would go into and so forth. So a lot of these articles there's about 200 of them. They're shareable as well. So
yeah,
for
definitely.
your own sort of reading and education, but
No
also
problem.
maybe
Yeah, we did have a few questions here.
share
One
it
of
as
them
well
was,
in your
can
own
we
updates.
transfer funds
Seeing
already in a
real estate investors
401k
coming up too.
or
And
IRA
the formal
into
poll,
your
maybe you can help me
self-directed
just
401k
with the
or
remaining time we
IRA?
have,
Currently,
10
they
minutes or
have
so. So I
a
know we're
sub-S
at
quota.
45 past the hour, and I'm a big stickler for trying to keep people on time. So maybe you can help me sort of navigate this part. Okay. So it depends on how it's set up. So if it's a current, one for a business and you're actively working there, typically active 401ks are not eligible to roll. So it's a caveat inside of the document. So if you're currently working at a place and you have a 401k, then you wouldn't be allowed to move those funds until you terminated employment from that place into a new account that you set up. Again, the specifics there are going to really relate to, and I'll do this part in here. So,
Okay. Okay, we had another question.
So the specifics are going to relate really to how the current plan is set up. So again, that's probably something that would have to be answered offline because it's going to be specific to your situation and how the current plan is set up and what type of account that is on whether it could be rolled in.
Okay, and then we did have another question. They want to know if they can roll money from an annuity that has reached its maturity date into a self-directed solo 401k.
Any old 401k can move into any IRA, whether it's traditional at a place, at a big box shop like Fidelity, or a self-directed one that you create at Rocket Dollar or one of our competitors as well. So if the annuity, again, you'd have to look at the documentation. So if the annuity is purchased with qualified monies, so if it was an IRA account that purchased that annuity, if it's a taxable, if you purchase it with after-tax money, quite frankly, you wouldn't want to move it into a tax-deferred account, and you wouldn't be allowed to. But that would depend on how the annuity was purchased. But let's, for the sake of the question here, assume that it was an IRA that own the annuity. The annuities reach full maturity, so it's transferable without triggering the withdrawal or the surrender charges, and it can be moved into a solo 401k. The clarification is if it's a qualified account monies going into a qualified account. That's why it could be IRA to IRA, 401k, old 401k to IRA, and so forth, or old 401k.
Okay, and someone wanted to know if someone has a regular 401k with Voya, how do you convert those funds to a self-directed 401k?
System, that won't allow a disallowed transfer type. So one of those might be that you can't transfer a Roth IRA into a traditional IRA. Our system won't let you do that, but you also can't do it either. Yeah, so I'll assume that this is an old 401k. So the person used to work at a company. The 401k provider was Voya Financial, and now they no longer work there, and they want to convert to a solo 401k or a self-directed IRA. So what a lot of people do in the IRA space, and you're going to find this even if you went from Voya Financial to Fidelity, is that a lot of times they give you the option because there's no tax consequences for doing so. That you basically go through, you set up the new account with a Rocket Dollar type provider if you want to go into real estate with those old accounts, and then you have an account number with us, and then you go into our digital transfer system, and then those instructions that you'll give to Voya will actually instruct them to liquidate that account to cash. So you might have had 3 or 4 or 5 mutual funds for a total of $110,000, for example. And then you're instructing them to liquidate that, go to cash, and then once it settles in as 110,000 in cash, the cash will get swept over into the Rocket Dollar 401k or self-directed IRA and goes into the bank account. There's no tax consequences for doing so. So the short answer to your question is that yes, old 401ks managed by Voya, and I know for a fact that we have transferred monies from Voya directly ourselves as a company at Rocket Dollar. We've actually transferred monies away from 62 different financial companies into Rocket Dollar.
Okay, somebody also had almost the same question, but theirs was safe harbor. I don't know if that would be almost the same answer then.
Probably has an eligible institution that not only can you move monies away from to us, but we've probably specifically done it from that institution to us as well. Well, safe harbor is a type. So again, this is kind of going back into my prior life. So the 10 years I spent at Merrill and then in management consulting, I probably consulted on a lot of large corporations' retirement plans. So a safe harbor is a type of a retirement plan. And again, if you're no longer working at that company, but it was a safe harbor 401k,
and someone want to know,
whatever, $90,000.
Okay, and someone want to know if there's any age limit to have a self-directed 401k.
One of the other major 401k providers, and that's eligible. So that safe harbor only refers to how you got your match paid to you at your last company, if it's a previous company plan. Yeah, it's not a type the way that Roth is. Yeah, so so there is no age limit to having a self-directed 401k, but after I use the number a lot, 59 and a half, which is the minimum age you have to be to just have unfettered access to start taking monies out of an IRA or 401k, assuming it's not a place you're currently working at in the 401k space. But at the age of 70 and a half, because we talked about this earlier, you've been kicking the tax payment on your own monies down the road for a very long time. At 70 and a half, the government has decided that they need to start collecting some of these taxes that you owe, and you're getting pretty close to your life expectancy. So you're required to start taking monies out. So there isn't an age restriction for when you can start these accounts, but at a certain age, you will have to take monies out no matter what and start paying taxes. Um, so again, that's a kind of there's a lot to unpack in there. Usually, I've gotten a lot of these same questions over almost 2 decades now. So when people ask me that question, there's some caveats to where if you set up a solo 401k and you're still actively operating in business and you might be in your 60s already, you think to yourself you can't start a new plan, but you can. Um, and you can make contributions, but after the age of 70 and a half, you will also be required to take some monies out on a yearly basis based on a formula that the IRS has set that any accounting software or tax professional is going to know. And the reason why they know it
Oh
is
yeah,
that
definitely.
not taking monies out of an IRA after 70 and a half has the highest percentage penalty of anything in the U.S. It's 50% penalty
And then
if you don't take
somebody, this a couple
It's huge.
people had
You were supposed to
concerns
take
about it. They
out
said like
5,000 in
it
annuities.
sounds like they need to
You're going
know
to
quite a
be
bit
penalized
more than a
2,500 bucks.
traditional realtor to recommend these to their
The
clients.
percentage is
And then
worth
someone
it.
said, does Rocket Dollar partner up
Little
with
IRS
the
trivia for you.
realtors to
Those
inform
listening.
their buyers investors?
Yeah, so in a way, we're just the facilitator of the account structure themselves. So we don't have any formal partnerships with realtors or the big real estate agencies and so forth. But you know, one of the things is that these accounts are kind of set up, and once they're there, people know how to operate these accounts on their own. Essentially, it's an IRA account. They're basically just owning the properties inside. We actually kind of take the view that the hardest thing is identifying the great investment properties themselves. And this is a well-worn path. Many people have done this, and this is another reason why I'm actually suggesting that people kind of look into this maybe for themselves, because it allows you on this webinar to basically sock away a lot of money for your own retirement by capitalizing on expertise in a field you're already involved with. Um, um, and basically creating a financial plan for yourself. So what I found is the vast, sort of majority of real estate professionals don't really have their own sort of retirement plan set up. It's because they feel like, well, I don't work at that big company and there is no 401k for me. And I think once you probably do this for yourself, you'll have a very good understanding of sort of how to operate these accounts, even on by just
Okay.
presenting the
And
investments to
then somebody wanted to know when you were talking about the strategies, they're talking about
your
strategy
role is
number
going to be to
two.
find that
They wanted to know if you can
find the
make the
great investment
mortgage
property
note
for them
out
to
to
own.
yourself.
And then after that, it's not going to be that different than them basically just owning an investment property with taxable monies themselves. So you can't do yourself. So these are things that would come up inside of the knowledge-based questions. So an easy rule of thumb without me going into all the minutia and the details are that when you're using retirement monies, it can't be anything that directly benefits you or a direct relative. There's a reason why and I'll use an example that probably a lot of folks on this call can directly relate to, because these are the things you have conversations with your own prospects and clients about. Um, that when they're trying to get underwritten for a mortgage for just a regular real estate purchase, that you don't give any consideration to the monies inside of 401k or IRAs. It's because the tax advantage accounts, the tax qualified accounts, can be used as a part of the underwriting criteria
Okay, and then
to for the person's ability to pay back on a mortgage. So that same rule
oh, okay.
also
And then when you were
indicates that
talking
you
about like
can't
strategy three, this
utilize
question
IRAs
came
or
in. They want to
401k
know if it
monies to
could be
benefit yourself
used
directly. So the
in a
note has to be to
partnership or
someone
in an
that is
LLC
arm's length
investment
from you.
or acquiring a small business.
So it can't be your son, daughter, mother, father, or yourself or spouse on the notes. Yeah. So again, if you're acquiring the small business that you plan on running, I know that online there's a couple of companies that have these sort of weird workaround structures for setting up the stock for the businesses to acquire a business that you may run with your IRA dollars. I think that again, it goes against the spirit of the rules I just talked about, which is benefiting yourself ultimately. You're just creating a workaround structure to do so. So we advise our customers to not basically invest in businesses that they're going to control. So that's why we talk about the ability to be a minority passive investor in a business that you believe in, as long as you don't have any control or outsized ownership stake. So you can purchase equity in a company, but the general rule of thumb is that you have less than 10% and no sort of board position within that company if you do that. But there's a lot of online businesses that are showing people how to take monies out of an IRA and buy a franchise, for example. And from what I can see, they're creating an interesting sort of corporate stock structure to do so. But again, the spirit of the rule is to not benefit yourself directly. And I feel like that no matter how you sort of set it up.
Okay, and then I had a couple questions about the self-directed 401k. One is how much would it cost to open one? And then the other, what is the maximum deposit per year a client can contribute per year?
In the gray area, which is to advise customers no, not to do that. Mm-hmm. Yeah, so the pricing is the same for us for the IRA or the 401k. So in our particular case, and this pricing will vary with providers, is for us it's $360 initial sign up and then $15 a month, whether you open an IRA or whether you open a 401k. And then the amount that you can contribute to the account is so this year, and this is what's tricky, it changes every year based on the IRS, just like the amount of money you can put away into an IRA changes every couple of years. But for 2019, it is $19,000 of salary deferral. And then anything above that is a percentage. It's 25% of your income up to an IRS maximum of $62,000. So that formula works out to basically 260 to 275,000 in top line income for you to do the maximum contribution. But you can put away the first $19,000 of your salary as a deferral to yourself in a 401k. And this is important because there may be many of you, we haven't gotten this question or maybe in the queue, and this comes up a lot too. And again, schedule time, you can talk to someone on my team about it. A lot of real estate professionals do a SEP IRA, and a SEP, the contribution that you can make to a SEP IRA is always some percentage. It's always 20% of or 25% of your income. So for you to put away $10,000, you have to have 40,000 of income. But that same person that qualifies for a SEP almost always qualifies for a solo 401k as well, and they could do the first $19,000 of that 40,000 in income if they choose to do so. So maybe they have another income source, a spouse, is a doctor and makes 300,000 a year. That you just want to shield the income as much as possible that comes in. So the reason why the solo 401k is kind of a hidden, underutilized tool in financial planning is that dollar for dollar, anyone who qualifies for a SEP can put away more money into a solo 401k with less top line income. Now, if you're making 300,000 or 275 or more, it's not going to matter. You can max out a SEP and a solo. But that adjusts on a year-to-date basis. And Paul, you weren't a part of this, but when we were setting up this webinar, the reason why we wanted to do it in calendar year 2019 is that when the rules are that you have to set up a solo 401k in the calendar year that you want to basically lower the taxable income for. So we have a lot of people right now, we're running a campaign to where people are opening up a solo 401k with us right now. And then up until the time when they file their taxes, they'll determine how much they can put into the plan. But they have to have the account opened in 2019 to take advantage of it. Now, I know that this is probably a little bit too late. I mean, we would have preferred to have done something in November, so people had time to answer these questions. But it's exactly why
Oh,
people are always racing to make those last minute IRA contributions before April 15th. Or for those of you that are running your business, your accountant or your tax professional is probably giving you calls before you file your business returns to say, hey, you could kick over another 6,000
okay.
into your
And
SEP,
does
and
someone know if the
it wouldn't change
401k
your
was
it wouldn't
established with
change
the
anything. It's
former
actually just beneficial
employer
for
and the
you to do
person
so.
is
Otherwise, you
retired
lose a lot of
above 60? Is that
taxes
okay to convert
from
it
that.
to a 401k
So advanced
self-directed?
things, long answer to the question, but does become that it's adjusted on a year-to-year basis. In 2019, it happens to be $19,000 of salary deferral is the limit for a 401k. um, if their business setup allows them to do so. So again, I don't know if so. The qualifications for setting up a solo 401k are that you basically are your own business person. So you have an LLC, you're a consultant, you're a real estate professional, and it's just you. And even if you're part of a larger agency, for example, like I am, I'm still obviously every dollar I earn, they're going to generate a 1099 for me. So I'm still an independent business owner inside, even though I have a franchise um, with a large agency. So if I have that set up and I'm an independent income earner, then I can open up a solo 401k. And if the 401k, the one that you want to roll in, qualifies to do so, like you no longer work there or you're of a certain age and the rollovers are allowed, and you qualify to open a solo 401k, then you can move monies into it. So, like again, it's specific to the
Okay,
situation.
now,
So I can't say 100% if that's eligible to roll over. The one that it's usually better for me to establish on mediums like this in a public forum are to make sure that you have a business or employment setup that qualifies you to even establish the solo 401k.
okay.
And
And if somebody
typically in
wanted
an
to know,
audience
they
of
said they'd be
independent real
interested
estate
in moving
professionals, it's almost
IRA
always going to be
money
the
to a
case.
new solo 401k. Does
But it
that
wouldn't
work?
be if I were talking to engineers at LinkedIn or Microsoft or something. They would all be working for one large company, and the only people who would qualify for a solo 401k are maybe the couple that do real estate independent of that work on their day job. That does work. So IRA so the biggest thing that we do right now is that we roll over people's existing IRAs into either a solo 401k they create with us or a self-directed. So you can move IRA monies into a solo 401k. But then you just want to look if the IRA happens to be a Roth IRA, then you have to go into a self-directed Roth solo 401k. So that tax treatment would need to be consistent. But IRA to 401k is a very known path of transfer that we do facilitate. And again, people on these types of calls might realize that, hey, I have an IRA, but it looks like I can do more with my solo 401k, especially as an independent real
Okay,
estate
and then somebody want to
professional.
know if you
I
can
could make a small loan
redirect
to myself if and when
SEP
I need it.
IRA funds.
I could make larger contributions on an annual basis. It's 6,000, if you recall, for your customers, for example, that they can put away into an IRA on a yearly basis. It's up to 62,000 if you make enough income per year for a solo 401k. So big difference in what you can contribute. When you say redirect, so
Okay, and
again,
if
SEP
someone want to know
IRAs
if you
are
can
it's a
use the
SEP is
solo
a form of an
401k
IRA,
account to make a purchase of
which
a
we do
house
have some SEP
that would be
IRA
your primary
customers as well.
residence, or is this
But
only
if you
applicable
feel after
to investment
basically
properties that you will
talking
not live
or doing
in?
your own research or talking to us that a solo 401k is a better fit for you, a SEP IRA can be moved into a solo 401k as well because it's just a type of IRA. Only applicable. So again, if in any way it benefits you personally, like you getting the ability to live in the house, then it's a disallowed transaction with a 401k or IRA. It has to be something that you do not plan on living in. So people don't. This has to be a pure investment property. So this wouldn't even be, a vacation home that is kind of half and half. Like sometimes you use it, most of the time you rent it out. This has to be pure investment property all the time. So even that, so you cannot purchase your primary residence with the account. And this question came in, of course, but it just fits under
Okay.
that sort of
And somebody just want to know in general,
informal
like,
role
how are Rocket
you
Dollar's
benefit
fees
personally
compared to
anyway,
other large
even you or
investment
someone that's so
companies?
close to you that it's almost benefiting yourself too, like your daughter or your son, for example. And if the answer to that is yes, then the answer to being able to use this account to do so is no. So, yeah. So against the other self-directed type providers, I like to think that we're very competitive. So we just basically put everything into one sign-up fee. So that's a one-time fee for anyone who becomes a customer of ours. And then the ongoing, what I typically say is that the types of transactions we've been talking about on this webinar, residential real estate purchases, doing a note, getting a loan to yourself, they're of a dollar amount to where I've kind of always made the justification in how my own tax professional, gets me to keep paying for her services year after year, which is the amount I pay them for doing my returns and helping me with it is probably less than what I would end up paying in taxes. So we like to think that 15 times 12 is 180. Our average customer account is a six-figure account right now. So $180 a year for the ongoing maintenance is probably far less than what they're avoiding or saving in the form of otherwise taxable investment operations than what they would pay us. So against the other self-directed providers, I think that we come in a very competitive price point and also very easy to understand because it's just basically two tiers, 360 or 600 and 15 or 30 on a monthly basis. And then against the big investment houses, all of those companies are probably predicated on not charging any amount of money for opening or maintaining the account, but where they make money from all of us as clients and customers is off of the investments inside. So in a way,
Okay, great.
if you own a mutual fund at Fidelity, you're probably paying them 1% of the management fee of that mutual fund is the only way you're paying for the services. In my case, I charge you for opening the IRA and letting us maintain it for you, but I'm not charging you 1% of the house that you bought on a yearly basis, if that helps. So I like to, so against the big box, it's just a completely different business model, um, is what I think. And that's what you're going to find, especially if you get comfortable with this and you start talking about it with, potential clients. Like my whole thinking is that you don't necessarily need to become the expert on the IRA. You're directing them to a provider like Rocket Dollar or similar. Your expertise and your ability to establish additional value to potential clients or existing clients in your database is by being able to bring this up. What you're going to find is going back to that financing, knowledge, and difficulty. People don't know that they can do it. Um, and when they do find out, it's difficult and usually really expensive. But you're going to find out that people are interested in doing something different, especially if your clients are pretty well to do and they might have six-figure, mid-six-figure, and higher accounts inside of just three mutual funds, and they don't pay attention to the account on a day-to-day basis. So this is kind of what I've dealt with for almost 20 years. It's fascinating to me that people have large amounts of monies in these accounts and they're not actively involved day to day because mutual funds have kind of done a good job of
Oh,
not
interesting.
requiring the end
And somebody want to know
investors to look
if
into it all day long.
what is the security of moving
I
your
tell
money
people
to
that
Rocket
you
Dollar
may
from,
not think so,
say,
but you
Morgan
probably own
Stanley, for
Snapchat and
example?
Uber because they're both in the S&P 500. Even though you tell me that you don't believe in the business model of either company, it's very likely that most American people actually own both of those companies inside of their index funds. Yeah. Yeah, so so we actually don't, as a company, touch any of the money. So it actually goes into an FDIC insured bank partner account of ours. So essentially, it's a national bank charter that holds the monies for your account. Again, we're functioning mostly as the administrator, so we're not the holders of the money as well. So that's one of the things. So the money never comes to Rocket Dollar directly. We go directly from a Morgan Stanley IRA or a Fidelity IRA when it goes to cash into an FDIC insured bank account.
And if someone want to
So
know,
the
is
movement of money
there
actually is going to be pretty similar to when someone,
oh, okay. Someone
say
want to know
bank
if there's
accounts.
I'm
We
sorry,
have a
a
couple dedicated
RMD
chapters
for a
acting for both
401k at some point.
FDIC insured national bank charters with licenses to operate in all 50 states. So they're the holders and movers of the money. We're more the trackers and the administrators of the account. And that's how a lot of these IRA providers go ahead, Paul. So there is when you're after you're no longer working. So if you're actively working and contributing and generating new income, then the RMDs will not apply. Again, you know, there's a lot of nuances in how that particular part works or not, because as you can imagine, the government is kind of tilted towards starting to collect their RMDs. But if you're actively employed and actively generating income and contributing to a 401k, then of that particular part, there wouldn't be RMDs. But if you have other IRAs, then you will have to pay RMDs on that after age 70 and a half. And again, your tax professional will be
Okay, and someone want to know, is it better to use a Roth IRA or traditional IRA to transfer to self-directed 401k for real estate investing?
The only thing you have to worry about is that people have multiple IRAs at multiple places. So the amount that you have to send in an RMD, if you're required to do so, is across all the accounts. So yeah, so that's I would tell you right now that if you were to get 25 or 30 economists and academic professionals and tax professionals, um, ironically enough, you're going to find out that it's actually going to be split down the middle. And the reason why is that you're really just deciding to pay taxes in today's dollars or pay taxes later. So the idea is that I'll give you an example of why not Roth real quick, and then the example of why Roth. And the reason why it would be split down the middle is that it could be argued that we're actually at relatively low historic tax rates right now. And it's not known that you might be making tons and tons of money later in life, even when you're older than you are now. So if tax rates are low now and the tax regime changes and they decide to up the rates quite a bit, then you would benefit from having a Roth and paying the taxes in 2019 because the rates went way, way up. But then it could be the opposite. The rates could be lower in the future, and you wouldn't have wanted to do a Roth, for example, because they went down. So it just depends. I think the biggest determinant for us, just so you know, is that most of the people that we have as customers are no longer able to contribute on a yearly basis to a Roth IRA going forward because their income is too high. So the vast majority of our customers have traditional IRA accounts, and then sometimes people decide to pay a chunk of money to the IRS upfront and convert an IRA to a Roth. But again, that was their personal decision to say that I think that the rates are low today and going up in the future, for example, to do so. And I believe that so much so that I'm going to send $50,000 today to convert my $200,000 IRA to a Roth. And they're going to send $50,000 in cash today to the IRS to make that conversion. But again, I would actually say that that's a kind of a personal decision, depending on what you think and what might be best for you specifically. Because to say Roth is better than
Oh, great. And someone want to know if you can still, if a person can still invest in a real estate IRA account if they are over 59 and a half.
In your own situation. Hope that helps. But that's a really good question at the end, because I would actually argue that that's probably one of the eternal questions out there in financial planning. Yes, so you can. So if you're over 59 and a half, you can. So the only thing at 59 and a half is that you can start taking money out. Um, I'll give you, maybe it's easier for me to answer that with just a concrete example. This person's still on that. We have people that decide to get out of their brokerage accounts at a Morgan, or brokerage IRA accounts at a Morgan Stanley once they're 60 years old, to go to a real estate professional to buy 3 properties. Now they're 61 years old. They open up an account at a place like us at Rocket Dollar. Then they go to the real estate professional, you, and say, hey, I want to find 3 properties, you know, that generate income. But now that I'm over 59 and a half, I want the rent checks to actually come to me and I'll pay taxes on it.
Oh,
But I
great.
want the houses to
And
be
somebody
inside
wanted to
the
know what was,
IRA for the property appreciation potential.
oh,
I
and
want the
somebody
rent
wanted to know
checks
what
because
was
I want to
the
live off of them. And
age
they can do that
one
because they're
needs
over
to be to
59 and a
roll
half.
over funds
If
from
someone
a
were 49,
401k.
the rent checks, if they own a house in an IRA, would have to stay inside of that IRA as they come in. They can't spend it without a penalty from the IRS. So yeah, so you can still own the account. Go ahead, Paul. So it's not based on age. It's just based on, whether you're coded as a terminated employee from that previous employer. And many people on the call, actually, we live in a day and age now where you may have had many previous employers, many of which may have had retirement accounts. And if you no longer work there, it's completely up to you to open an IRA and decide to start consolidating in. That's something that we find ourselves doing a lot on the front end, is helping people
Okay, and someone
consolidate
wanted,
2 or 3 accounts so they can accumulate a larger dollar amount into one Rocket Dollar
oh yeah, that
IRA or
makes sense.
401k
And someone wanted
with
to know
us
if
so they
there's
can go
also,
make
if
a
there's a
property
limit to
purchase.
how many
So they have enough, but it's
401ks
in
you
three
can
old
have.
accounts, 30,000, 80,000, and 50,000. And then they roll all 3 into one with us, and now they have enough to go buy a property inside. So it's not based on age, it's just based on, you're no longer working at that company. So there's not a limit on how many you can have, but to make contributions to it, I refer to that $19,000 as what you can put in as a deduction from your income. That is also across all of your 401ks. So if you have a day job at Microsoft and you put $10,000 of your 100,000, 10% of your $100,000 salary there into the plan, that's 10,000. Then if you
Okay.
have another
And
401k
they
with
also
us,
want to
then you could
know,
only do
is money
9,000.
deposited with Rocket
So
Dollar
there's not
guaranteed
a
or
limit per se
protected
on how many
by
you can
any
have, but
agency?
of course you'd be paying for a lot of different accounts if they're solo Ks that you're doing with us, and then it would probably start to get a little burdensome to make sure that you don't put away too much money and run afoul of the rules for contributions as well. Yeah. So again, the money that's deposited into Rocket Dollar is technically inside of the same protections and treatments you'd get in a bank account. So at our level,
Okay. And
we
someone
don't,
wanted to know
certify or guarantee the funds through like
if
a
do you
SIPC,
guys
which is in the
does
brokerage
Rocket Dollar
industry, or
pay
FDIC,
referral
which is in
fees
the banking
if they send
industry.
people to you?
But your money is going into a bank account, a national charter bank account. So they're the ones certifying that the money's going in are protected, just like the money in a bank account, if that helps. So we are establishing partnerships like that. So what happens right now is that for every person that opens an account with us, so let's just say right now you open up one individually for with us, then inside of your own dashboard, if you become the customer first, then you have a personalized referral code that will give the referee $100 and will give you 100 in the form of a gift card. And then if you're a larger, I don't know exactly the audience here, but we also have a more formal one where we could do a code specific to your agency. So if it was like Coldwell Banker or something like that, or this team at Coldwell Banker and it's 90 agents, for example, then it might be easier for us to have you talk to our marketing and partnerships team to create a code specific for that. And at a high level, so just so you know, that we typically give away $100 on account sign up, and we let the referrer pick if they want some of that to go to themselves. So we have a lot of people that will take advantage of the $100 off coupon, so they could generate one for, let's say, Paul Paul 100 off coupon, or Paul 50 off coupon. And the arrangement there is that for everyone who uses that code, we send you $50, Paul, directly, and then the end
Oh,
customer will
great.
get $50 off of their
And
account.
someone want to know if they
And for
just
other
open up
people, they
like
may say, I want all 100 to accrue
if they
to
open
my
up a core account,
referee, and I don't
do
want
they
any
need to
of the
provide
dollars.
the bank
Just
account
something
information
to
to
keep
you?
track of. So give the person all 100. So we let people decide on a lever of how much they want to keep and how much they want to pass on to the referee that they're bringing to us. Yeah. So there's a whole partner stage thing. Yeah, go ahead. So the bank account that we give to you, we open the bank account with our partner bank for every person. So we'll be the
Okay,
one creating
and
that bank
someone want to
account.
know, so just a
And that's going to be the
trustee to
same with
trustee
Core or
transfer is needed
Gold.
to move from
So it
one
has to be
account to
with our
another?
partner bank. So you're going to establish a brand new bank account to be able to work with us. So the way it works is everything is newly established for you, and that's all included in that 360 or $600 fee. Yeah, so trustee to trustee, it depends. We'll look at the accounts that you're
Okay.
rolling money in
And Henry, I
from and
just have
determine what's the
about
most
two more
efficient.
questions. I'm
If
sorry
it
to
is
keep you
trustee
on
to
so long,
trustee, whether it's
but they're
trustee to
very
trustee
interested.
rollover,
So,
direct transfer, it's going
in,
to
every,
depend.
in your knowledge, so are the
But in most
contribution
cases, it
dates
is
by
trustee to
12/31
trustee
or by
transfer because
the
then
date you
you
file
can do as many of
for
those in a
that
year as you
year's
want.
taxes?
If you do
Like,
rollovers, you can only do one
is
per calendar year.
oh, go ahead.
Sure. Hey, no problem. Yeah. No, I know what this person is asking about. So the contributions that you'll make into your self-directed IRA or self-directed solo 401k, the contribution deadline is when up until you file your tax return. So whether that's for your business on the solo 401k or as an individual, which would be April 15th, including extensions, by the way, too. So extensions would do that. But let's say on an individual basis, the contribution deadline for a self-directed IRA is April 15th. And the difference between an IRA and a solo 401k or a solo 401k is that the IRA can be created. Let's say hypothetically, you're talking with your tax professional, and they say, "Hey, look, you could actually get a deduction for contributing to an IRA, so you should just open one right now if you don't have one." And you could do that if you're having a conversation with them on March 15th of 2020 and open the account and then fund it before your tax filing on April 15th, 1 month later, and then code that contribution as the 2019. But in a 401k, the account has to be opened in 2019, even though the contribution to that 401k doesn't need to be made until you're doing your final filing of your taxes for your one person business, your real estate business, presumably, for folks on this call. So that's the caveat. The solo 401k has to be established in the calendar year, but the contribution doesn't need to be made until you're filing you're finalizing your
Okay, and if
taxes. The
someone is
IRA
receiving
can
Social
be opened
Security, they're older than
after the
68,
calendar
and
year
they
end in
also have a
2019,
401k with a previous
funded
employer,
by
can
your
they open a
filing
self
deadline for the
401k?
2019 return. So that's why we have a lot of people opening solo 401ks now, knowing that in a few months they're going to decide later how much they're going to contribute to it. So if they're actively producing business in a one person, if they're actively producing income in a one person business, they can open the self directed solo 401k with us. And again, you'll have to talk to your tax advisor on whether you're required to take some distributions out of the account. The reason why you'd open it with us,
Okay, great. You know
is
what?
presumably
I
that you would get the
think
added
that is
flexibility
it.
to
I'm
buy
going to
things like
flip
real
over
estate
to this
instead of
final
what this
slide.
person
It has
probably had in that old 401k,
all
which
of
is like
Henry's information is still on this slide.
the taking
And
or
then
not taking Social
also
Security.
we have the link
Actually
for
doesn't
the
have direct effect on
evaluation.
this.
You
All that
can,
really has
that's
an
an
effect
actual
on
link
what
on the
your
slide. You can click on
taxable
that
income
where it
is.
says webinar evaluation. Let us know what you thought about today's webinar. And then to get your credit, there's that webinar affidavit link over there up at the top. And I'm going to be sending you an email as well as soon as we sign off here and with the directions on how to do this. But if you're on the webinar still, if you click webinar affidavit, it takes you to CRS.com. You'll see RRC webinar affidavit. You open it up, put in your initials, hit submit. That's all you need to do. And yeah, there's no other questions. And we just have our next webinars on Wednesday from likes to leads, how to use Instagram for business. Registration is open for that. That's on Wednesday. And then on Friday, Lee Brown's going to talk about planning for 2020. And that will finish it up for the year. That one on Friday is free to all RRC members. So you can register for that. And like this, you'll get the recording if you're not able to attend. Before we get out of here, Henry, is there anything you wanted to add before we get out of here?
No, I think you could set up, talk to us in the chat and or get a lot of those questions answered. I know that I answered that many of them are specific to your situation, and that's just kind of the nature of the beast when you're dealing with investments and taxes.
Okay,
There's
great.
no
That
real
sounds great.
blanket answer
Yeah,
for
send that
everything.
over,
So,
and I'll shoot an email over to
there
Nikki
to
to
basically
get
take
that.
advantage of
And I
those
just wanted to
for you.
thank you again,
And I'll tell you
Henry,
what, by
and
the
especially
time
for
you send
staying
out
on
the
late
email,
and making
I'll get
sure
Nikki
we
to work
did
with
get
you.
everybody's
So I
questions
think we do
answered.
have a
I'm
coupon
sure
code
about that.
generated for folks in this one. So at the
And
very
I
least,
just
they get
also
their
wanted to
first
thank
$100
Rocket
off
Dollar for making all this
if
possible
you're
as
starting an
well.
account with us too. So
Remember,
thank you
Rocket
for
Dollar
that.
account holders have the power to invest in any asset class allowed by the IRS, invest securely and easily in real estate, startups, and more. Open a self-directed solo 401k or self-directed IRA with Rocket Dollar and put your money to work today. Thanks again, Henry, and thanks again to Rocket Dollar. And with that said, I hope everyone has a great rest of the day, and we'll see everybody next time. Thanks, Henry.